Welcome to week 1 of our 5-week trading bootcamp. Over the next hour, we'll build the foundation every successful trader needs. How the global forex and crypto markets actually work, the 3 chart styles you'll see on every platform, and how to read a single candlestick so it tells you who's really in control. Buyers or sellers. Master these basics today and the tools we cover in later weeks: support and resistance, indicators, multi-time frame analysis, and risk management will slot neatly into place. Keep a notebook ready, pause the video whenever you need to, and dive in with an open mind. Let's get started. Let's start by taking a panoramic look at the global foreign exchange arena and see where 2 hugely traded alternatives, gold and Bitcoin, slot into the picture. The Bank for International Settlements' most recent triennial survey shows that in April 2022, spot and derivatives desks moved roughly $7.5 trillion every single day, making FX the deepest financial market on Earth. Trading never really sleeps. It rolls west with the sun. From Sydney to Tokyo, on to London, and finally New York, streaming quotes from Sunday 2200 UTC to Friday 2200 UTC. Liquidity reaches its maximum when London overlaps New York. That's when European banks, US dealers, and the big electronic networks are all logged in. Inside this flow, you'll find central banks adjusting reserves, commercial and investment banks making markets, hedge funds and multinationals hedging cash flows, and a fast-growing wave of retail traders connected through online brokers. Gold, quoted as XAU-USD, now trades about $227 billion a day, putting it in the same liquidity league as many secondary currency majors, most of it during London bullion hours and the New York COMEX session. Crypto never closes. Yet its volume still swells during those same London and US windows. This week, the digital asset complex is turning over roughly $100 billion a day, led by Bitcoin, Ethereum, and the big stablecoins. Across all 3 arenas, liquidity means you can move size quickly at minimal spread. EUR/USD often costs less than half a pip, gold a cent or two, and Bitcoin just a few dollars when spot volume tops 20 billion. Knowing when that deep liquidity appears and which instruments attract it will shape the timing, sizing, and risk settings of every trade you place from here on. When traders say they're doing analysis, they're really putting on one or both of 2 lenses and looking at the exact same price chart from different angles. First comes the Y lens. That's fundamental analysis, interest rate announcements, inflation prints, payroll numbers, even surprise comments from the Fed or the ECB. One unexpected policy tweak can launch Euro-USD or Bitcoin hundreds of points in minutes. Keeping up is no longer a full-time job. A quick glance at the free calendars on investing.com, TradingView, Forex Factory, or MyFXBook tells you what data is due and how big a shock it might be. In crypto, on-chain dashboards like Glassnode and news feeds such as CoinDesk flag network upgrades, ETF filings, and fresh regulation, catalysts every bit as powerful as a central bank meeting. The second lens asks a different question. Where next? That's technical analysis. It ignores the headlines and reads price itself, individual candlesticks, layers of support and resistance, moving average crossovers, patterns like the double bottom you'll see on the screen. The logic is simple. People tend to react the same way in the same circumstances, so patterns that reversed price before have a habit of doing it again. The most consistent traders don't pick sides, they blend the two. Fundamentals narrow the menu. Perhaps the dollar looks strong ahead of a likely rate hike, while technicals say exactly when to move, which trims risk and sidesteps whipsaws. Over the next sessions, you'll practice both approaches until using them together feels as natural as breathing. Now that we know why prices move, let's look at how that movement is displayed on your screen. Almost every trading platform offers 3 core chart styles, each built from the same raw data: open, high, low, and close. but each telling the story with a different emphasis. Line charts are the simplest. They plot only the closing price of each period and connect the dots. Because the intra-period noise is stripped out, line charts excel at showing the big picture trend and major support and resistance levels. They're perfect when you want a quick sanity check or when you're comparing multiple assets side by side. Bar charts, or OHLC charts, add more depth. Each vertical bar shows the full price range for the period. A small tick on the left marks the open, a tick on the right marks the close. Bar charts reveal volatility, how far price stretched before settling, but they can feel a bit abstract until your eyes adjust. Candlestick charts take the same OHLC data and wrap it in a more intuitive visual. The distance between open and close forms the body. The thin lines above and below are the wicks or shadows that capture the high and low. If the close sits above the open, the candle is usually colored green or white, signaling bullish pressure. If the close is below the open, it's red or black, signaling bearish pressure. Because the body makes buying and selling pressure instantly obvious, candlesticks have become the default choice for discretionary traders analyzing everything from Euro USD to Bitcoin. Whichever chart type you prefer, remember they're all telling you the same story, just with different levels of detail. Use line charts to spot the forest, candlesticks to examine individual trees, and bar charts anytime you want the volatility context without color bias. In the next section, we'll zoom in on the candlestick itself and learn to read the emotions hidden inside a single bar. A single candlestick packs an entire battle between buyers and sellers into one simple icon. The body stretches from the opening price to the close. If price finishes higher than it opened, the body is usually colored green or left hollow. Bulls won that round. If price closes below the open, the body is red or filled. Bears had the upper hand. The wicks, also called shadows, mark the extremes. The upper shadow shows how far buyers managed to push before supply pushed back. The lower shadow shows how deep sellers drove the market before demand firmed up. Long shadows on either side signal strong rejection of those extremes. Read enough candles and patterns emerge. A long wick hammer, for example, often appears at the tail end of a down move on Bitcoin or Euro USD. Sellers force price down, buyers snap up the bargain, and the session closes near the top of the range. Evidence that momentum may be shifting. Stack 2, 3, or 4 of these pattern clues together, and you start to build a quantifiable edge. Single candles can tell you a surprising amount about crowd psychology if you know what to look for. So let's read them as one unfolding story rather than a list of definitions. First, imagine a candle with no shadows at all. It opens at one extreme and closes at the other, never looking back. That's a Marubozu, a full commitment bar. When it's white, buyers control every tick from start to finish, and the session often kicks off a bullish continuation. Flip it black, and the sellers own the tape just as decisively. Sometimes, though, the market hesitates. Oh. Spinning top. Plants long wicks above and below a tiny body. Both camps throw punches, but neither lands the knockout. Stretch that indecision even further, and the open and close become identical. You've got a doji. After a long run, a doji warns the order flow is balanced, and a turn could be brewing, but you still need the very next candle to prove it. Then come the one-bar reversal alerts. Take a small body and bolt a long lower shadow underneath it. If that prints at the tail end of a decline, sellers forced price down, but buyers snapped it straight back. Classic hammer's behavior and a potential bottom. If the same shape pops up after a rally, we rename it a hanging man and treat it as a caution flag that fresh selling pressure just surfaced. Now flip the whole image. Small body with a long upper wick. At the end of a slide, it's an tipon, inverted hammer, hinting bulls are testing the water. At the crest of a rally, it becomes a shooting star, showing bulls pushed higher but bears slap the move away. The thumb rule is simple. A long shadow marks a price the market just rejected. And traders remember those extremes. Always wait for confirmation, ideally a close beyond the pattern's high or low, before you act. On a Bitcoin daily chart, for instance, a hammer at 28,000 is just a curiosity until the next candle closes above the hammer's high. Only then does it become a trade-worthy, higher probability setup. The exact same logic works on a 4-hour Euro-USD chart. Build a mental catalog of these one-bar clues, notice where they appear, and later in the course we'll layer them on top of support and resistance and indicator signals. That's how simple observation turns into a measurable trading edge. Here's what you should be able to do before moving on. First, open any platform and instantly spot which chart type you're looking at: line, bar, or candlestick. And explain the anatomy of a single candle: open, high, low, close. Second, recognize the high probability one-bar signals we covered: Marubozu for momentum, doji and spinning tops for indecision, hammer hanging man and shooting star pairs for potential reversals. You don't have to memorize every variation yet. Just train your eye to notice them in real time. Finally, your homework. Pick 3 live charts: one major Forex pair like Euro-USD, one crypto chart such as BTC-USD, and a third of your choice. Take a screenshot of each, circle at least 2 clear candlestick patterns, and label them. The goal is simple repetition. The more patterns you mark, the faster they'll jump out at you when real money is on the line. Bring those annotated screenshots to next week's session. We'll use them to overlay support and resistance and start building a complete trading setup. Welcome to week 2 of our 5-week trading bootcamp. Last session, you learned how to read a single candlestick and identify the basic chart types. Today, we add the horizontal and diagonal grid that professional traders overlay on every chart. First, you'll learn to draw support and resistance, the price levels where buying or selling pressure repeatedly shows up. These zones act like psychological floors and ceilings. Knowing where they sit keeps you from buying into a wall of sellers or setting stops where everyone else is hunting for liquidity. Next, we introduce the Fibonacci Toolkit. You'll see how retracement levels such as 38.2% and 61.8% often align with prior support or resistance, giving you an objective way to size pullbacks and trends on both Euro-USD and Bitcoin. Finally, we'll layer in moving averages. You'll discover why a 20-period EMA hugs price action for short-term momentum, while the 200-period SMA defines the long-term trend that institutions respect. By the end of this module, you'll be able to combine these 3 tools to find high-probability trade zones, places where price, Fibonacci geometry, and average trend direction all agree. Have your charts open and last week's homework screenshots handy. We'll build directly on the levels you labeled. Price never travels in a straight line. It pulses between zones where buy and sell orders quietly stack up. The floor that keeps catching falling candles is called support. The ceiling that keeps batting rallies away is resistance. Each time price bangs on one of those doors without breaking through, the door gets stronger. Yet when it finally splinters, it often swings around and serves the opposite role. Yesterday's ceiling becomes tomorrow's floor. Stretch either level on a slope, and you have a trend line. In an up move, you let the chart draw its own angle by connecting successive higher lows. In a down move, you link the lower highs. Two clean touches sketch the line, the third confirms it and forces you to accept the market's geometry instead of your bias. Clone that line and slide the copy to the other side of price, and you've built a channel. The lower rail of an ascending Bitcoin channel becomes a buy the dip zone. The upper rail, a logical place to scale out or tighten stops. Flip the logic for a falling channel on a 4-hour Euro USD chart. A few field notes. Horizontal levels that show up on several timeframes carry extra authority. The very first break of a famous level is often a head fake. Wait for a candle to close beyond it before you believe. Next slide, when we layer Fibonacci on top, watch what happens when a 61% retracement lands exactly on old support. That kind of confluence is gold. For homework, take last week's screenshots. Draw at least 3 horizontal levels, ink in the dominant trend line, and, if the structure permits, clone it into a channel. Label each touch point so the scaffolding is crystal clear when we start planning real entries and exits. Fibonacci ratios hand you a pre-drawn roadmap that traders everywhere already watch, which means those levels often become self-fulfilling hotspots. Start with the pullback numbers: 23.6, 38.2, 50, 61.8, and 78.6%. In an uptrend, you anchor the tool at a clear swing low and stretch it to the swing high. Any dip that tags the 38 or the 61 band is where resting buy orders tend to appear. Flip the anchor points for a downtrend, and the same percentages become ceilings where short sellers reload. Then come the projection ratios: 1.0, 1.382, 1.618, and so on. These sight beyond the swing and serve as objective profit targets. If you're long euro-dollar from that 61% pullback, the 1.382 extension is a logical first take profit. Bitcoin traders use the same grid on the daily chart. Rallies often stall or consolidate right at the 1.618 extension of the previous impulse. The real magic shows up when levels converge. A 50% retracement that lands exactly on an old horizontal support or on the lower rail of an up channel concentrates order flow. The more technical elements that point to the same price, the higher the odds that price will react there. But remember, Fibonacci is framework, not trigger. Treat the levels as areas of interest, then bring in confirming evidence, maybe last week's hammer candle or next slide's moving average crossover, before you pull the trigger. Moving averages are nothing more than running averages of past closing prices, yet they're one of the most versatile tools in a trader's kit. By smoothing raw price action, they reveal the underlying trend and filter out intraday noise. The trade-off is speed versus stability. A simple moving average, SMA, treats every closing price in the look-back window equally. That makes the line smooth, but it also means the SMA reacts slowly to sudden price shifts and can leave you a step behind a fast move. An exponential moving average, EMA, tilts the weight toward the most recent candles, so it hugs price more tightly and flags trend changes sooner. But that responsiveness can also amplify whipsaws and fakeouts. The period you choose controls how quickly the MA responds. 20-period tracks short-term momentum. Many swing traders use a 20 EMA to trail stops. 50-period defines the medium-term bias. A close above the 50 SMA on Bitcoin's daily chart, for instance, often signals a maturing uptrend. 100 and 200-period averages smooth out months of action and show the institutional view. Funds rarely fight a market that sits above a rising 200 SMA. A popular way to turn these lines into concrete signals is the moving average crossover system. When a faster EMA, say the 10 or 20, crosses up through a slower SMA like the 50, that golden cross marks early trend acceleration. The reverse death cross warns of emerging downside. Just remember that any MA-based method is a lagging indicator. It confirms a trend that has already started, so pair it with price action or an oscillator to avoid chasing the very tail end of a move. Practical homework: overlay a 20 EMA and 100 SMA on both Euro USD and BTC USD daily charts. Note how the 20 EMA bends first, how the 100 SMA anchors the broader move, and log 2 crossover examples where they lined up with the support and Fibonacci levels you plotted earlier. Everything we've covered so far becomes far more powerful when you stack the tools in a logical sequence. Step 1. Identify the active trend with a moving average crossover. When a fast EMA, say the 20, pushes up through a slower SMA such as the 50, you have objective proof that bullish momentum is taking over. Flip the rule for a bearish cross. This single event tells you whether to hunt for longs or shorts and keeps you from fading strong moves. Step 2. Project a Fibonacci retracement to map a safe pullback zone. Anchor the Fib tool on the most recent impulse leg in the direction of the crossover. In an uptrend, common buy zones cluster around the 38% and 61% bands. In a downtrend, they become rally points for fresh shorts. You're essentially telling the market, show me a discount inside the dominant trend, and I'll get involved. Step 3. Park your stop beyond the next key support or resistance. Horizontal levels or channel rails act like natural speed bumps. By hiding the stop just outside that structure, you reduce the odds of being wicked out by intraday noise while still limiting risk to a defined amount. Put together, the flow is trend confirmation, value entry, structurally sound exit. Run this checklist on last week's Euro USD screenshots or a live BTC USD chart, and you'll see how confluence sharpens your edge. Your mission this week is to glue the 3 new tools together on a single chart and prove you can spot a high probability setup without my help. Step 1. Pull up the Euro USD daily chart. Zoom out so you can see at least the last 6 months. That gives you enough swing structure to work with. Step 2. Draw your primary trend line. In an up move, connect the 2 most obvious higher lows. In a down move, use the lower highs. A third touch validates the line. Step 3. Clone the line to create a parallel channel. Slide the copy to the opposite side of price action. This instantly frames logical profit targets and stop-loss zones. Step 4. Add a Fibonacci retracement. Anchor it on the most recent impulse leg in the trend direction. Swing low to swing high for longs, swing high to swing low for shorts. Mark the 38% and 61.8% bands. These attract the heaviest order flow. Step 5. Hunt for confluence. Circle any price area where a fib band overlaps the trend line and sits near a prior horizontal support or resistance. Those stacked factors create the sweet spots professional traders watch. Step 6. Jot a trade idea. For each confluence zone, write entry trigger, e.g., bullish hammer rejects the 61% band. Stop location, just beyond the opposite side of the zone. Target, channel opposite rail, or the 1.382 fib extension. For your deliverable, screenshot the annotated chart, paste your notes underneath, and save it as Week 2 EUR/USD confluence.png. Bring it to the next session. We'll grade the zones together and layer moving average crossovers on top to complete the checklist. Welcome to Week 3 of our 5-week trading series. Over the last 2 sessions, you learned to read price itself, first through candlesticks, then through structure, Fibonacci geometry, and moving averages. Today we add a new layer of confirmation: indicators, classic chart patterns, and intraday pivot points. You'll see how momentum and volatility tools like MACD, RSI, and Bollinger Bands reveal the strength or weakness behind every move. We'll decode high-probability chart patterns, triangles, double bottoms, head and shoulders, and show you why they work just as well on Bitcoin's 4-hour chart as they do on EUR/USD daily. Finally, you'll learn to calculate floor trader pivot levels that institutions still use to set intraday targets and stops. By the end of this module, you'll be able to line up trend direction, indicator confirmation, pattern breakout, pivot targets, creating a complete, rules-based trade plan. Fire up your charts and keep last week's homework handy. We're about to turn raw price action into a fully instrumented flight deck. Bollinger Bands are our first plug-and-play indicator. Picture them as a breathing envelope around price. The middle is a 20-period moving average, while the upper and lower rails sit 2 standard deviations above and below that average. So the whole envelope widens when volatility surges and contracts when the market goes quiet. 2 behaviors matter. First, the squeeze. When the bands pinch tightly together, volatility has dried up, and markets hate boredom. In the BTC/USD chart on screen, 12 candles were locked in a squeeze. The moment one closed above the top band, a $2,000 breakout exploded. Second, the bounce. Inside ranges, price loves to tag a band and snap back toward the center line. On last month's EUR/USD chart, you'll see 3 textbook bounces, each good for 40 to 60 pips. Trading it is straightforward. During a squeeze, wait for a close outside the bands and a pop in volume before you pull the trigger. During a bounce, marry the band touch with a reversal candle, a hammer, engulfing bar, or doji. Then aim for the middle band. Always filter the signal with context. Is the higher time frame trend up, down, or sideways? A bullish break above the upper band on gold that also clears last week's high carries far more weight than one trapped in chop. One common pitfall: never short a roaring uptrend just because price pokes its head above the top band. Bollinger Bands measure volatility, not overbought. Add an RSI or MACD cross so you don't step in front of a freight train. Master the squeeze and the bounce, and you'll own 2 repeatable setups you can deploy on any liquid market currencies, gold, even crypto, across every time frame. The next momentum gauge on our dashboard is MACD, the Moving Average Convergence Divergence. It's nothing more mysterious than the gap between two exponential moving averages, a fast 12 period and a slower 26. Plot that gap as a line, add a 9-period average of the same line as a signal, and you can see at a glance whether momentum is speeding up or stalling. The colored histogram underneath is simply the distance between the two lines. The bars swell when the gap widens, shrink when the market coasts. Watch what happens on the Bitcoin 4-hour chart in the upper right corner. Long before price actually breaks support, the MACD line slips under its signal and the histogram flips from blue to red. That bearish cross whispers a warning a full candle ahead of the price crack, giving you time to tighten stops or take the short. The lower panel shows another MACD superpower, divergence. Price grinds sideways, yet the indicator quietly prints higher lows. Momentum is rebuilding under the hood. When the line finally vaults the zero level, the tide line that separates bullish from bearish territory, Euro-dollar rips 90 pips almost in a straight line. Trading rules are simple. Use crosses only in the direction of your higher time frame trend. Bullish crosses inside an uptrend, bearish crosses inside a downtrend. Marry each cross to a confluence zone from week 2. Say an MACD turn that happens exactly at a 61% Fibonacci retracement resting on horizontal support. And you've stacked the odds in your favor. Treat the zero line like a tide chart. Above it, bias long. Below it, bias short. One common pitfall is waiting for the daily chart cross and discovering it lags miles behind the move. If you're swing trading gold, glance at the 4-hour to catch the momentum shift early. Then confirm the bias on the daily before committing full size. Lock in the cross and divergence combo, and you'll read momentum like a pro, instead of guessing when a rally is really out of gas or a sell-off is ready to turn. The stochastic oscillator is a lightning-fast gauge for when price may have sprinted too far, too fast. It simply compares the latest close with the high-low range of the last 14 bars. That reading is plotted as %K, and a 3-period average of it becomes %D. When both lines push above 80, the market is flagged as overbought. When they sink below 20, it's tagged oversold. Treat those bands as warning lights, not automatic trade buttons. Traders pull 3 signals from the study. First, the cross at the extremes. When %K slips beneath %D, while both are perched above 80, short-term momentum is stalling. On the gold chart in the top right corner, that very cross nailed the candle, where buyers began taking profits. Second, divergence. Price prints a higher high, but stochastic sneaks in a lower high. Momentum is wilting. The larger Bitcoin snapshot shows bearish divergence that foreshadowed a $1,200 pullback. Third, range trading. Inside sideways markets, you buy when %K hooks up out of oversold and sell when it hooks down out of overbought. In strong trends, though, the indicator can stick to the ceiling or the floor. In those cases, wait for a clean cross plus a confirming candle pattern before acting. A few pro tweaks sharpen the edge. Short-term scalpers can tighten the look back to 5 or 7 bars. Daily swing traders often lengthen it to 21 or 34. Use the oscillator only with the higher time frame tide. In an uptrend, hunt for bullish turns out of oversold and vice versa. And always add structure. An oversold stochastic that turns up precisely at a 61% Fibonacci retracement on Eurodollar is a far higher probability entry than the oscillator by itself. Read these momentum shifts well, and you'll spot the market when it's winded, just before the next sprint begins. The Relative Strength Index, or RSI, is a single-line gauge that swings between 0 and 100 and tells you, at a glance, which team has the upper hand. First, think of the 70-30 bands as warning lights. When RSI pushes above 70, it means price has climbed faster than its own recent average. Below 30 means the sell-off is stretched. In the Euro example on screen, price dives, RSI bottoms near 20, and the very next candle prints a bullish hammer, the classic oversold snapback. Next, treat the 50 line like a momentum tide. Above 50, the bulls run the tape. Below 50, the bears. Watch Bitcoin in the top right panel. RSI crosses up through 50 at the same moment price snaps a mini trend line. Momentum and structure are saying the same thing. Go long and ride the wave. RSI also whispers through divergence. Gold carves a lower swing low, yet RSI quietly prints a higher low. That bullish divergence flashes before a $30 rally unfolds. Here's the trading playbook. Use 70 and 30 as alerts, not instant reversal buttons. In a strong uptrend, RSI can camp above 70 for days. Wait for a crossback under 70 plus a reversal candle before you even think about shorting. Lean on the 50 line to stay aligned with the big picture. In an uptrend, buy pullbacks that drag RSI down toward 40 or 50, then hook back up. In a downtrend, sell rallies that push RSI up toward 50 or 60 and roll over. Always stack RSI with structure. An oversold reading that turns up exactly at a 61% Fibonacci retracement inside the lower Bollinger Band is a high probability launch pad. Add RSI to your momentum checklist, and you won't just know where price is, you'll gauge how powerful the current move really is. Before we fuse all our momentum tools into one checklist, it helps to park each indicator in its rightful family tree. Family 1 is the leading crowd, the oscillators. These guys aim to sniff out a turn before price actually pivots. They swing between fixed extremes and shine when the market is sideways or only drifting slightly. In the top left chart, you can watch stochastic and RSI take turns flashing overbought and oversold warnings, while price chops inside a box. Family 2 is the lagging crowd, the trend followers. They don't guess. They confirm that real momentum is already underway. Moving average crossovers and the MACD histogram live here. Look at the bottom right example. Eurodollar doesn't print its bullish MACD cross until buyers have punched clean through resistance. Perfect for traders who would rather join strength than pick tops and bottoms. So the workflow becomes almost mechanical. Oscillator first. RSI climbing out of oversold at horizontal support tells you something might be brewing. Lagging confirmation next. A fast EMA crosses above a slow one, or MACD vaults the zero line, proving momentum has arrived. Execution tool last. A parabolic SAR dot flips, or a candle finally breaks the alert level you drew back in week 2. Watch the top right USD chart. Stochastic divergence whispers early, but you don't pull the trigger until the dots flip and MACD rolls over. 3 green lights instead of 1. Use leading indicators to warn you, lagging indicators to prove it, then let raw price structure dictate the exact entry and stop. Stack the sequence and you'll avoid the classic mistake of shorting every overbought blip in a roaring bull run, or buying every oversold dip in a waterfall decline. When price compresses into a triangle, it's not drifting. It's coiling a spring for its next directional burst. The shape tells you which camp is wearing down. Start with the neutral version, the symmetrical triangle. Lower highs meet higher lows, volume usually dries up as the apex approaches, and neither side has the upper hand. Be patient. The edge comes from waiting for a full-body candle to close outside one of the boundary lines and a pop in volume. On a Bitcoin 4-hour chart, you'll often see the breakout run roughly the same distance as the triangle's widest part. Shift to the ascending triangle. Here, buyers keep hammering on a flat ceiling while each dip grows shallower. Bulls are clearly in charge. A close above that ceiling tends to ignite resting buy stops, and the move frequently travels about 1 triangle height. Eurodollar has printed 3 textbook examples this year on the daily chart. Flip the geometry, and you get the descending triangle. Sellers lean on flat support while lower highs squeeze price downward. Bias is bearish. Once the floor cracks, the drop can be brutal. Gold's 2020 summer correction is the poster child. When 1,850 finally gave way, the metal dumped nearly $100 in 3 sessions. Trading rules are simple. Draw both boundary lines and extend them so you can see the resolution zone. Add a momentum confirm, a MACD cross, or an RSI thrust to dodge head fakes. And park your stop just inside the opposite side of the pattern. If the break fails, you want out fast. Master these 3 triangle variations, and you'll spot energy builds long before the crowd, giving you a head start on the breakout. Some reversals announce themselves so clearly they almost write their intentions on the chart. Picture an uptrend that rallies, stalls, pulls back, then rallies again to almost the exact same high and stalls a second time. 2 peaks with a single valley in the middle sketch a perfect M shape, the classic double top. Draw a horizontal neckline through the swing low between those peaks. When a full candle finally closes beneath that line, it's the market's way of saying the buyers are out of fuel. Measure the vertical distance from the peak down to the neckline. Project that same distance below the break, and you have a high probability target, often $15 to $20 on a 4-hour gold chart. Flip the picture, and you get the double bottom, the W that floors a downtrend. Price drives into support, bounces, then tests that support again, usually on lighter volume or with a bullish candle like a hammer or engulfing bar, before lifting. Connect the swing high between the 2 troughs. A decisive close above that neckline flips momentum from bearish to bullish. The same height projection, this time upward, gives you a roadmap. When Bitcoin carved a textbook W around 25,000, the neckline break launched nearly a $5,000 sprint. The trading checklist is simple. Patience first. Wait for the neckline break. Volume second. A surge on the break confirms conviction. Thin volume warns of a fake out. Stops last. Hide your stop just beyond the second peak or trough because if price retests and beats that level, the pattern is dead. Learn to spot the M or the W in real time, and you'll often catch the exact moment one trend hands the baton to its successor. Few formations broadcast a trend change as clearly as the head and shoulders. Picture an uptrend that rallies, tops out, and pulls back. That first peak is the left shoulder. Price gathers itself, punches to a higher high, then retreats again. That taller peak becomes the head. The third rally is weaker. It stalls roughly where the first shoulder topped out, sketching a right shoulder. Link the two reaction lows underneath, and you have the neckline. When a full candle finally closes below that neckline, the message is blunt. Buyers who held through the head's peak have capitulated. Measure the vertical distance from the head down to the neckline, drop that measurement beneath the break, and you have the classic downside target. On Eurodollar this year, a 4-hour head and shoulders around 1.10 projected almost exactly 90 pips, matching that rule of thumb to the pip. Flip the picture upside down, and you get the inverse pattern that ends a downtrend. Two failed stabs into support form the shoulders, a deeper spike shapes the head, and once price punches up through the neckline, the new bull run is underway. A tight trade plan keeps you safe. You want volume to swell on the neckline break, conviction, not a whisper. If price snaps back and kisses the neckline from underneath, treat that retest as a low-risk add-on zone. Hide your stop just beyond the right shoulder, because if price claws back above it, or below it in the inverse case, the pattern is invalid. Master this silhouette, and you'll spot the exact moment control slides from one side of the market to the other, long before the crowd realizes a new trend has begun. Long before algos lit up every desk, floor traders used a back-of-the-envelope arithmetic trick to frame the day's likely battle lines. The beauty is that anyone can calculate it in seconds, so everyone ends up watching the same levels. Here's the recipe. Take yesterday's high, low, and close. Average them and you get the pivot point, the day's equilibrium. From there, add and subtract yesterday's range to sketch the bands. R1 equals twice the pivot minus the low. S1 equals twice the pivot minus the high. R2 and S2 come from adding or subtracting the full range once more. Extend to the math if you want R3 and S3 as outer rails. So how do traders use this grid? Range players fade the first touch of R1 or S1 and aim for a drift back toward the pivot. Eurodollar inside a quiet Asian session loves that mean reversion play. Breakout traders wait for a 1-hour candle to close beyond R2 or S2. That often flags a trend day. Watch how gold routinely blasts through R2 at the London Open on CPI or payroll mornings, textbook breakout fuel. Timing is everything. Liquidity peaks during the London-New York overlap. That's when the pivot bands either hold firm or snap. Trading them in thin volume hours can strand you in wiggles. A couple of pro tweaks. If an R1 level lines up with last week's 61% Fibonacci retracement, respect it as a harder ceiling. Check ATR. When volatility is shrinking, fade the first touch. When ATR is expanding, Gear up for the R2 or S2 break. Paint the daily pivot grid on your chart and you start every session with a no-guess road map. Just numbers the whole market can see. Everything we've covered only becomes lethal when the pieces snap into the same place. Picture block 1, indicator signal plus pattern breakout. Euro-dollar is carving an ascending triangle. Price finally punches through the roof. Interesting, but hardly enough. At that very tick, the MACD line also vaults the zero line. Momentum and structure are shouting the same message, so the probability of follow-through just jumped. Block 2 is your traffic light filter, the RSI 50 line. Above 50, the engine is in bullish gear. Accept only long breakouts or bullish divergence. Below 50, momentum tilts bearish. So short setups own the statistical edge. Staying on the correct side of that midline slashes false signals and keeps you flowing with the broader tide. Stack at least 2 independent signals, run them through that 50-line filter, and you've created genuine confluence. Your best friend when real money is on the line. All right, time to turn theory into muscle memory. Between now and our next session, hunt down 2 live breakouts in the wild. It can be a triangle, a double top, a head and shoulders, any pattern we drilled today. Each breakout must be backed by at least one momentum cue. Maybe a MACD cross, an RSI thrust through the 50 line, or a stochastic hook out of an extreme. Log every idea in your journal with 3 bullet points. Setup, what pattern you spotted and where it sits inside the bigger trend. Trigger, the precise bar, indicator signal, and price level that flipped the switch. Outcome, target hit, stop hit, or still in play. A screenshot and a short paragraph for each trade is plenty. Bring your 2 case studies to week 4 and we'll grade the confluence together. Welcome to week 4, the session where we stop staring at one screen-size patch of price and start zooming in and out like a drone pilot. We'll open with multiple time frame analysis. By scanning from the monthly map all the way down to the 5-minute street view, you'll feel the market's current. So you surf with the tide instead of paddling against it. Then we'll dip a toe into Elliott wave. You'll see the classic 5-wave impulse followed by a 3-wave correction. Learn a lightning-fast way to label those swings, and use Fibonacci projections to hunt for that explosive Wave 3 target. Finally, we'll bolt every tool we've learned into a rule-based trading system. Setup, trigger, stop, target, and position size. So when you press the button, it's with confidence, not hope. Grab last week's screenshots and a fresh page in your journal. By the end of this lesson, you'll know where the big wave is heading, when to jump aboard, and exactly how to manage the ride. Great chart readers work like pilots. First scan the horizon, then zero in on the runway. Zoom all the way out to the monthly chart. It reveals decade-long currents and the heavyweight support or resistance that can halt any lower time frame idea in its tracks. Step down to the weekly to see whether that big trend is still accelerating or flattening out. Now open the daily, your tactical map. Here you'll plant swing highs and lows and sketch the Fibonacci and pivot bands we drilled last week. Drop to the 4-hour and 1-hour windows only when the strategic picture is clear. On H4, you hunt for a triangle or flag that leans in the daily trend's direction. On H1, You drill down to the exact candle and indicator cue that fires the entry. The trade-off table tells the rest of the story. Daily, weekly trades are few but mighty. Wider stops, weeks of patience, bigger paydays. H4/H1 offers more chances and lighter drawdown, but you'll pay a little more in spread. 5-minute scalping is non-stop action. It demands total screen time and iron discipline. And the golden rule: never act on a lower time frame signal that contradicts the higher time frame tide. Line those dominoes up and your win rate improves before you even worry about entry tricks or fancy indicators. Now let's zoom out and in, because where you look changes what you see. First, start at the top with the monthly chart. It shows the decade-long trend and major support or resistance that can swallow any lower time frame setup before it begins. Next, drop down to the weekly. Here you'll see whether that big trend is still climbing steadily or beginning to flatten out. Then move to the daily chart, your tactical map. Plant swing highs, lows, and the Fibonacci and pivot bands you learned last week. These levels frame every trade you'll take on the lower time frames. On the 4-hour window, look for patterns, triangles, channels, triangle squeezes that align with the daily bias. These are your entry zones. Finally, on the 1-hour and 5-minute charts, you hunt for the exact candle, the indicator cross, or the micro pattern that fires your trigger. By always confirming your short-term idea against the higher time frame tide, you avoid fighting the current, and you filter out the noise that trips up lone chart traders. Remember, higher time frame equals direction. Lower time frame equals timing. Line them up and your edge grows before you even click buy or sell. Let's turn our attention now to a framework that reads crowd psychology like a map. Elliott Wave. Think of market moves as a 5-step advance followed by a 3-step breath. Waves 1 through 5 form the impulse leg, the raw power of a trend, with wave 3 almost always the longest, like Bitcoin's vertical surges or the euro's pandemic rally. Once that top is in, the market doesn't simply reverse. It corrects in 3 neat waves, A, B, C. Wave A breaks the trend line, testing the resolve of the new move. Wave B often fakes a comeback, luring riders back in. Wave C finishes the pullback, typically landing right on a classic Fibonacci band, 38% or 61% of the full impulse. Why use this? Because the geometry between those swings lets you project real targets instead of guessing. For example, Wave 5 often measures roughly the same height as Wave 1, and Wave C often equals Wave A in length. If you anchor your Fibonacci extension from the start of Wave 1 to the end of Wave 3, you'll often find that the 1.618 zone zeroes in on the peak of Wave 5. You don't need to label every minor wobble. Just identify the dominant 1, 2, 3, 4, 5 run, see where you are, and use ABC to gauge how deep the next pullback might go. That simple wave roadmap keeps you riding the big trends and sidestepping false turns. Exactly the kind of edge we've been building all week. Now that you've seen how Elliott waves map the big picture, it's time to stitch every tool into a playbook you can follow without hesitation. Designing a rule-based system tools are only half the battle. True edge comes when you boil your strategy down to unambiguous rules you can execute instinctively. Spell out every component. Setup: what market condition you're waiting for, e.g., price above the 100 SMA with a pullback into the 20 EMA zone. Trigger: the exact signal that fires the trade, e.g., a 5 EMA crossing above the 10 EMA and stochastic hooking out of oversold. Stop: a logical exit if you're wrong, 1 ATR below the swing low, or just beyond prior support, whichever is wider. Target: where you scale out, first take profit at 1R, next at the 1.618 fib extension, then trail with a parabolic SAR or lower time frame swing. Position size: risk no more than 1% of your account per trade, calculated before you hit buy or sell. Backtest relentlessly, load 2 years of historical data on EUR, USD, gold, and Bitcoin. Record every signal, stop out, and profit target. You're not chasing perfection. You're seeking a statistically positive edge you can stick with. Demo trade for 2 months. Run your exact rules on a paper account with live prices. This phase uncovers the little execution quirks and emotional spikes that a spreadsheet can't show. Once your backtest metrics, demo trading record, and mental comfort level all line up, you're ready to go live, confident that every future trade flows from a proven, repeatable system. Setup spotted, trigger executed, stop in place, target locked, and position sizing respected. Let's prove that simplicity can still pull real pips. First, the chart. We stick to the Euro/USD daily. Just one candle per day, no screen staring required. Next, the entry rules. Plot a 5-period EMA and a 10-period EMA. Go long when the 5 crosses above the 10 and RSI is already above 50. Go short when the 5 crosses below the 10 and RSI is already below 55, crosses below the 10 and RSI sits below 50. That RSI filter keeps you trading with momentum, not fighting it. Now, risk and exits. Risk 2% of your account equity on every trade. Close the position at the first of an opposite EMA crossover or a fixed plus 3R profit, 3 times your initial risk. Why this works. The 5/10th cross locks in the early part of a swing. The RSI filter blocks most whipsaws. And the asymmetric plus 3R target means you only need to be right about 35% of the time to grow your account. Finally, your homework. Backtest this strategy over the past 2 years, then demo trade it for 8 weeks. You'll see that even a ridiculously easy rule set can deliver, so long as you follow it without exception. Your assignment this week is simple. Turn everything you've learned into a living, breathing playbook. You'll deliver a single PDF, first name mtfplan.pdf, that walks through your entire multi-time frame process, from the monthly big picture scan all the way down to your 5-minute execution chart. Keep it lean and precise. A coach should be able to open your plan and hit play without asking a single follow-up question. First, define your market universe. List the currency pairs or other assets you'll trade and explain exactly why each one makes the cut. Next, map out your time frame stack. Show the top-down order, for example, monthly, weekly, daily, H4, H1, 5-min, and spell out what each time frame is responsible for, identifying the long-term trend, marking key support, resistance, refining entry zones, etc. Then, specify your setup and trigger. Describe the precise pattern, indicator signal, or price action event that will prompt you to press buy or sell. After that, lay out your risk rules. Include your position sizing formula, your maximum allowable drawdown, and the conditions under which you'll scale back or stop trading altogether. Once risk is defined, explain your trade management plan, where you'll place the initial stop, how and when you'll scale out partial profits, and the logic you'll use to trail remaining positions. Finally, close with your review routine. Detail how you'll journal every trade, track key performance metrics, and refine the plan on a monthly cycle. Export everything as a PDF, label it firstname-mtf-plan.pdf, and upload it to the group channel before next week. Your peers and I will critique every line, so be ready to defend your blueprint. This document is the foundation for your Week 5 demo trading exercise. Make it rock solid. Welcome to Week 5, Money Management, Psychology, and Your Trading Plan. This is the finish line and where most traders stumble. We've mastered charts, indicators, multi-time frame strategy, and even built a rule-based system. But none of it matters if you blow up your account or sabotage yourself between the ears. Today, we lock down 3 pillars. First, we'll demystify position sizing and risk of ruin math, then cement the simple 2% rule that keeps you in the game long enough for your edge to pay out. You'll learn exactly how to calculate your per-trade risk, how many lots that means in your platform, and why staying small when you're wrong is the single best way to avoid ruin. Next, we tackle the mind. You'll discover how to recognize fear, greed, and revenge trades before they hijack your keyboard, and use a journaling routine that turns every emotion into actionable data. We'll build a pre-trade checklist you can't break, so your mindset stays as bulletproof as your system. Finally, we'll weld your risk rules and mindset checkpoints onto the technical framework you drafted in Week 4. By the end of this session, you won't just have a chart edge. You'll have a step-by-step script you trust under pressure. Have your draft plan, a calculator, and an open mind ready. You're about to discover exactly how much to risk on the next trade and how to stick to that number when the market tries to knock you off balance. Edge is worthless if you size it badly, so let's wire some guardrails into your plan. First, risk no more than 2% of your account on any single trade. The chart shows why. 19 straight losers at 2% risk still leaves a $20,000 account above $13,900, whereas risking 10% would have wiped you down to about $3,000. Small bets keep you in the game long enough for probability to pay off. Second, target a minimum 3-to-1 reward to risk. With that ratio, you can be wrong 6 times out of 10 and still grow the account. 5 $1,000 losses paired with 5 $3,000 wins nets you a cool $10 zero in profit. Third, track drawdown like a hawk. Lose 50% of your capital and you need a 100% gain just to break even. By sticking to 2% risk per trade, the hole you dig never grows so deep you can't climb back out. Follow these 3 rules: 2% risk, 3R targets, and strict drawdown control. And your account will run like a marathoner, not a sprinter who collapses at the first hill. You can have a brilliant strategy and perfect risk rules, but consistency lives or dies on discipline. discipline over strategy. A mediocre edge executed flawlessly will outperform a genius system you keep second guessing. In the heat of battle, your only job is to follow the checklist you wrote in calm weather. No debates, no improvisation. Reframe every loss. Every red trade is tuition, not failure. Judge yourself on process. Did you size correctly, place the stop where you intended, and document your rationale? The market's roll of the dice is random. Your execution is what you control. Keep a trading journal. Immediately after closing a trade, jot 3 lines. What did I see? How did I feel? Did I follow the plan? In 2 weeks, you'll uncover emotional patterns, hesitation, revenge clicks, FOMO entries that no indicator can reveal. Review your journal every weekend, double down on what works, delete what doesn't. Master these habits, and you'll turn randomness into data, fear into rules, and yourself into the most reliable part of the entire system. All the pieces we've covered, strategy, risk, mindset, now fold into one living document, your master trading plan. Think of this as the script you'll follow every day, no improvisation. Block 1. Rules, routine, and mindset. Start by pasting in the exact entry and exit rules you validated back in week 4. Then layer on your daily routine, pre-market scan, a quick position check at lunch, and a journal review after the close. Finish with a 2-line mindset checklist, something like risk less than or equal to 2%, no impulse trades. Read it out loud before every session so it becomes second nature. Block 2. Smart goals. Next, set your targets in SMART format. Your outcome goal might be grow equity by 4% per month, compounded. Process goals could include log every trade within 15 minutes or hit the gym 3 times a week to keep decision fatigue low. Make each goal specific, measurable, achievable, relevant, and time-bound. Block 3. Monthly review and refinement. On the last trading day of each month, compare your real results to the plan. If your win rate is off but your average R multiple exceeds the target, consider widening stops rather than scrapping the system. Iteration, not overhaul, turns a good plan into a great one. Follow this cycle. Execute your rules, measure your outcomes, refine your plan, and your trading framework will evolve with the market while your discipline stays rock solid. Here's the safe launch sequence. First, demo trade your complete plan for about 2 months. Treat your paper account exactly like real money with the same lot size, stop placement, and journal routine. The goal here isn't profits, it's mechanical execution under real-time conditions. Next, use any free broker demo or TradingView's paper trade module and log at least 30 trades. That volume will stress test your rules through good markets, bad markets, and every spike in between. Then, scale in gradually. Go live with micro lots first, step up to mini lots once your equity curve and emotions hold steady, and only pull standard lot triggers when you know the system and your nerves are rock solid. Think of it as flight school. Solo a Cessna long before you captain a 737. Finally, commit to continuous education. Markets morph, volatility regimes shift, central bank policies evolve, and new assets like tokenized treasuries appear. Set aside an hour each week to read research, review your journal entries, and tweak the plan. Follow these 4 blocks: demo trading, structured logging, gradual scale-in, and ongoing learning, and you'll enter the live arena with muscle memory, not butterflies. Congratulations, you've just crossed the finish line of our 5-week boot camp. Now it's time to publish and present. Convert your written trading plan into a polished PDF. Then record a quick screencast walking through a live chart. That way, future you or anyone holding you accountable can see exactly how your rules unfold in real time. Next, find a tribe. Join a trading community or small mastermind and post your weekly results. There's nothing like friendly eyes on your equity curve to keep discipline sharp and ego in check. Finally, keep the flame alive. Markets never stand still. Volatility regimes shift, policy pivots happen, new assets emerge. So stay curious, keep your risks small, and treat this graduation not as a finish line, but as your passport to lifelong trading growth.